For the first time in history, the U.S. could be weeks away from defaulting on its debt. It essentially means the government is not able to pay its bills, and the fallout could be devastating for millions of Americans. Joining us to talk about what this means for you and your family and your money is Brian Levy from BML Wealth Management. Brian, good morning. Good to see you.
Morning. Thanks for having me.
All right. So, Brian, can you talk to us about what the debt ceiling is exactly, and how will this impact Americans if it's not resolved?
Yeah, Adrian, I like thinking about it, as personal finances. That's the easiest way for me to understand it. The debt ceiling is like a credit card limit, right? So if you have a credit card, it's the amount of money you have the ability to borrow on your credit card. And really, this is the biggest credit card in the world, right? The U.S. government. So the credit limit, or the debt ceiling, if you will, is just the amount of money the U.S. can borrow to meet its existing obligations, not future. A lot of people think it's about future. It's what's already on the credit card and making sure they have to deal with that. This is nothing new, Adrian. This has been going on since 1960. Congress has dealt with this for 78 different times. They've had to do something with the debt limit or ceiling. So this isn't new. What is new is if they were to actually default on it, and that would cause a spiral of events at that point. We need a decision by October 18th. I read the Treasury Secretary's letter to Pelosi talking about how imperative it is to get this kind of debt ceiling addressed by October 18th.
Brian, how much is the debt right now? And if this thing goes poorly, could this trigger something like we experienced with the recession a decade ago?
Yeah, so the debt's a staggering 28.8 trillion with a T, as we know, and it's just going up every year. I mean, if you go back to thinking of like your personal finances, the government's, let's say, earning $30,000 a year, and they're spending $60,000 a year. I mean, that's literally what's going on right now. So, and it's not to say that the spending wasn't important during COVID, but you're right. If it doesn't come to a resolution and the U.S. government actually defaults on their debt, that could cause potentially a recession, because now you have the stock market. We saw what it did as we got close to that in 2011. We saw what happened. The U.S. got downgraded in their credit rating. That creates everybody getting concerned, getting scared. People pull money out of the U.S., not only just the stock market, but the bond market. We're seeing that there could be impact on Social Security payments, even though it's its own trust fund. And it says it's funded to the year of 2034. If we have a government shutdown and we can't spend to pay those government workers, we're going to see a delay in Social Security payments to the Social Security beneficiaries. And Social Security has never missed a payment. There's 50 million people on it. That's a big deal. But when you say recession, I always think about inflation, rising interest rates. We all know costs at the grocery store have gone up. But the reality is, if the government is not as successful and they don't actually get this passed, what's going to happen is a lot of people are going to charge the U.S. more to borrow money, right? They're not as creditworthy, and that's going to cost us Americans a lot more when we go out and do things.
Mm-hmm. Wow. All right. A lot to take in there. Brian Levy from BML Wealth Management. Brian, thank you for joining us. If you want to get more information about this, you can get it from Brian and his financial services by going to bmlwealth.net. Thank you, Brian.
Thanks, Adrian.